in the previous lectures, we have talked about Bitcoin from a technological point of view. And I think that's fair for a university class. After all, I want to give you the tools that you need to understand how Bitcoin actually works. But when you're looking on social media, or when you're reading some articles in newspapers or watching the news, then people are usually interested just in one thing, and that is Bitcoin price. And even though I personally think that's unfortunate and probably the least exciting thing about Bitcoin, it's certainly something people are interested in. Now, one thing you really have to be aware of are people who are telling you that they can predict Bitcoin prices, and I'll show you some fancy models where they supposedly can tell you what the Bitcoin price will look like tomorrow. And in this lecture, I will show you some of these models and why I think they are inherently flawed. All right, let's get started. You probably remember this table right here. I think it was part of the second lecture of this class, where I made the argument that any monetary unit, or any asset for that matter, can be described in terms of its value by three components. So number one is the intrinsic value right here. That's the question whether you can consume it or whether you can use it directly in the production process. So it's the value that is still present even though nobody else would have a demand for it. So it's just you interested in this asset. Can you do something with it, for example? Then the promise of payment or promise for delivery. That's an attached value, if you want to call it that way. For example, you have a paper slip that says, I'm going to promise to deliver 1 ounce of gold to anyone who presents this paper slip to me, as a simple example. And I think we also talked about that. It's really this attached promise. So it's not the physical unit itself. It's not the virtual token itself. It's really that something external is attached to this asset. And that's where the value comes from. And then the liquidity premium. And the liquidity premium essentially is just the option to market that good, to market that monetary unit for something else later on. That is why it's called liquidity premium. So it essentially is your expectations, how easily you can sell that good later on, how easily you can exchange it for something else. So when you have a really high liquidity premium, this means that it will be really easy to exchange it later on for something else. When you have a really low liquidity premium, this means you will have a really hard time. And also that right here basically is the only component present in fiat assets when you have no intrinsic value. So when the asset can neither be consumed nor used in the production process, and also no attached promises, no attached promise for payment, promise for delivery. And this is true for the Swiss franc. For the Swiss franc, I mean, you cannot consume it directly. You cannot use the Swiss franc itself, meaning the paper slip or the coins in the production process itself. Of course, you can buy things with it, but not the Swiss franc itself. And all the value you have in there is basically the liquidity premium. So the option, your expectation that you can later on trade it for basically anything you desire, anything you want. Okay. With Bitcoin, it's quite similar. It's also entirely expectation driven. You don't have any intrinsic value. You don't have any promise of delivery. Nobody guarantees you to give you a specific amount for a Bitcoin. You cannot consume your Bitcoin or use it in the production process directly. It's really just this liquidity premium. It's really just this additional value component. The expectations that you can sell it later on, the expectation that you can still use it later on, and that is the only component in Bitcoin's value, which is really important, because now what we're going to do is we will look at various valuation models, so pricing models people came up with. It will be somewhat disappointing because I will show you that most of them, actually all of the models we will look at today, don't make too much sense, that they are severe simplifications, that you have to be really careful. A good rule of thumb is whenever somebody claims that they can predict the Bitcoin price, run away. I mean, it doesn't make too much sense when you have an asset that is entirely relying on the expectations of people, as entirely relying on everyone else's expectations and somewhat volatile expectations, of course. Then these predictions don't make too much sense. So Bitcoin's value, as I said, is solely determined by its liquidity premium. So by this part, there is no intrinsic or value or promise of payment. Now, one thing you hear surprisingly quite often about in the context of Bitcoin is discounted cash flow. And I mean, it should be rather obvious that this does not make any sense whatsoever. I assume most economists in this class are familiar with the discounted cash flow model. The idea is that you have an asset, and this asset pays either dividends or interest. So you have this periodic return where you get something, and what you're doing is basically you're calculating these returns with a discount. So you take an interest rate, you discount the future returns of that interest rate, because you're saying any future returns should be evaluated a little less than what I'm getting today, because there is some uncertainty, because I cannot use it immediately. And so, for example, you have this cash flow 1 right here in the first period, so 1 plus the interest rate to the power of 1. Then you have cash flow 2 with 1 plus the interest rate to the power of 2, and so on. You do that until period n, and that is basically your discounted cash flow that you're getting. And this allows you to value an asset and come up with some approximation what an asset should be worth. But with Bitcoin, I mean, you don't have any cash flows. And with stock or bonds, you have, as I said, dividends. You have interests. For most financial assets, you can use models like that. But with Bitcoin, there are no cash flows. A Bitcoin is a Bitcoin. A Bitcoin doesn't pay anything. You don't get any interest. You don't get any dividends. It's just your Bitcoin. It's in that regard, it's quite similar to gold. And also with gold, obviously, when you have physical gold, you cannot compute a discounted cash flow model. It doesn't make too much sense. Now, the next thing you hear about quite often, it's quite popular, and when you're looking for Bitcoin pricing models or Bitcoin valuation models, you will definitely hear about it. It's the stock to flow model. And the stock to flow model, it's also used for various commodities. The general intuition is quite easy. It says you have some stock right here, so capital MT, that's the stock of the asset for time period T. So how many Bitcoin are actually out there on the market? And then you have some flow for a given period. That is usually 1 year. So here you would have delta MT plus 1. So that would be the inflow, the delta MT for this period MT plus 1. So how much is coming in? And what you're doing with the stock to flow model is you're looking at this relation right here. So you have the stock MT, so that's right here, divided by, this is basically your delta MT plus 1, because when you think about it, it's MT plus 1 minus MT, so it's really this delta you're having here. So it's stock divided by flow. And this can be used, at least that's what the proponents of this theory claim, as some sort of an approximation for price. Now, from an economics point of view, again, it doesn't make too much sense, because what you're approximating here, what you're looking at, is just the supply. And as you all know, when you want to predict prices, or when you want to look at markets, then it's always the combination of supply and demand. And when you just look at the supply side and making the argument, okay, there is so much stock and that much coming in, therefore the price must be here or must be there, it doesn't make too much sense. I could easily come up with an example where I create, let's say, my own cryptocurrency, or where I create, I don't know, I'm crafting something, and there's a certain stock, and then I decrease the inflow, I decrease the flow every period. But still, when nobody cares about it, when nobody is interested in it, or when the demand changes significantly, then we cannot entirely rely on stock and flow, of course. It's always this relation between a demand and supply, and that is why this model is inherently flawed, and I'm not a big believer. It doesn't make too much sense from an economic point of view. That being said, you will still find it pretty much everywhere on the internet. You still should be really skeptical. As I said, theoretically, it doesn't make too much sense, but you have to be aware that it's out there. And what's interesting is when you're looking at it from exactly the other way around. So when you're dividing flow by stock, then essentially you have the monetary growth rate. We will look at that later on in this slide deck. Now, when you think about Bitcoin supply, you have to realize, first of all, maybe you focus on the theoretical path right here. So on the gray line, you have to realize, and I think I've shown that it converges to 21 million. And the reason for this convergence is because it halves the introduction rate of new Bitcoin, the minting rate halves every 4 years. So here, for example, I had the first phase where 50 Bitcoin have been introduced, and then 25, and then 12.5, 6.25, and so on. And this reward rate, this issuance rate gets halved and halved and halved and halved. And obviously then you have some convergence to a value. In the case of Bitcoin, that is this 21 million that happens in the year 2040, where you have an approximately zero growth, and then 2140, somewhere around there, if Bitcoin would still be around, where you would have an actual zero growth, so where the last few fractions of Bitcoin also have been issued. Now, when you look at this, and this is really important, there is a difference, there is a deviation from the theoretical part to the actual path, and this is because the threshold value, so the difficulty in mining, is only adjusted every 2016 blocks. So this should be every 2 weeks, but of course when you have deviations, when you have a sharp drop in computational resources within these 2016 blocks, then this will be longer than 2 weeks before the threshold value can be readjusted. When it's much faster, then this will be shorter than 2 weeks, and as you have seen, then of course after these 2016 blocks the difficulty will be adjusted once again. But this, when you have some drops, for example, that was the case right here, then it can take significantly longer than expected. On the other hand, when you have a constant increase in computational resources, so when it's always faster than it should be, and you adjust this threshold value and it gets smaller and smaller, so you have an increasing difficulty over a really long period of time, then you're usually ahead of the theoretical path. Now, what's certainly interesting is comparing the Bitcoin monetary supply, or the growth rate, to the US dollar growth rate. And as you can see right here, with Bitcoin, it started out really high. That's rather unsurprising. When you have just 50 Bitcoin from the Genesis block, and then you add another block, block 1, that also generates 50 Bitcoin, then you would have a 100% growth rate just from one block to the next one. Whereas when you already have, let's say, 1 million Bitcoin in circulation and you introduce another 50 Bitcoin, then the growth rate would be much slower, relatively speaking. And that's just because there are already more Bitcoin in circulation. Now, in addition to that effect that creates essentially this curve right here, in addition to that effect, you have the reward halving we've just talked about. So every 4 years, there are 210,000 blocks. The reward, the introduction rate of new Bitcoin, the minting, will be halved. And you can see an example right here. So then you have additional drops in the growth rate of the monetary supply for Bitcoin. And as you can see right here, and that is really the entire idea behind Bitcoin, is that while it was heavily inflationary in the beginning, where there was a lot of Bitcoin introduced, and essentially there was some debasing. It wasn't necessarily inflation, because in many cases the price still went up, but it certainly was debasing, where the market cap was divided by many more monetary units, and these monetary units have been introduced with a really high frequency. The introduction rate came down quite significantly, and these days is much lower than what we're seeing with many of the fiat currencies, particularly as you can see here with the US dollar, that is in somewhat unprecedented territory, at least in modern times, and with the US dollar. And we'll see where it goes. We don't know, but the hope or the idea of Bitcoin proponents is that this very limited growth, that this convergence towards this fixed supply of 21 million will help long-term stability. And that's probably something you also have to differentiate. While Bitcoin certainly has really high volatility in the short run, and that's essentially why I make the argument that it's not necessarily a really good payment instrument, at least not for everyday purchases. It may potentially be really interesting in terms of its mid to long-term characteristics, because it's not debased anymore. And if demand keeps up and people are still interested in Bitcoin, this may be really favorable and might actually have really interesting characteristics as a long-term store of value. Now, if that will be the case, we don't know. There can be so much going wrong. And as you have seen, it entirely depends on the expectations of the people, since it is an asset that doesn't have any intrinsic, any fundamental value, and no attached promises. So it entirely relies on this liquidity premium and on the expectations of people, but it certainly is possible. And the idea, the general intuition of Bitcoin, so of this decreasing introduction rate, if this decreasing growth rate, is quite similar to what we're usually seeing with gold, for example, that behaves similarly. Now, there are some very strange claims. For example, one thing you can see right here is the Bitcoin price with a log scale. And then in the shaded areas right here, you can see again these reward halvings. So always at the start of the shaded area, that's when a reward halving has happened. So basically when the Bitcoin reward dropped from 50 to 25, from 25 to 12.5, and from 12.5 to 6.25. And what you can observe right here, that's just a casual observation, is that always after these halvings, the price increased quite significantly. And this led people to argue that the Bitcoin reward halving always will lead to this rally, because obviously when you're introducing less Bitcoin, then everyone wants to buy this Bitcoin, and that's why it has to go up. Now, economically speaking, once again, this doesn't make any sense whatsoever, for one simple reason. You can perfectly anticipate, well, almost perfectly, I mean, to be fair, it's probabilistic to some extent, but you know it's coming, and you know approximately when it is coming. So everyone knows about these halving events. It's not a surprise whatsoever. And now let us go with a thought experiment. Let's say, for example, you know with certainty that after these halvings, and again, I'm not claiming that is the case. I'm saying it's a flawed argument, but let's go with the thought experiment. You're saying after these halvings, price will increase by 100%, okay? For reasons. When we know that a price would increase at a certain period in time, 100%, then obviously you would be inclined to buy it today at a much lower price. Everyone else would also be inclined to buy it today. It's basically an intertemporal arbitrage where you have the opportunity to buy something much cheaper, and you know in a relatively short period of time it will be worth much more. And what would this do? So if the community, if everyone involved would know with certainty that something should be worth 100 Swiss francs, let's say, and today it is at 90, then everyone would just buy these 100 Swiss francs worth of assets today for these 90 Swiss francs, and this would drive up demand and would put the price much closer to these 100 Swiss francs again. So if you know that something should be worth 100 Swiss francs in the future, then economically speaking, game theoretically speaking, you will see this exact price increase minus a potential discount factor for time preferences today. So what I'm saying is, you can price it in, okay? If everyone knew that after this halving Bitcoin must be here, then you would already see it before the halving. You would in fact see it right when this information was public. And that's why, economically speaking, it does not make any sense that the reward halving should have this price effect afterwards. You will only observe immediate price effects with a causal relation when there is some surprise announcements. So I don't know when, it's much easier to make these examples with stocks when there is some news about a company, but with Bitcoin also when there would be some amazing technological proposal coming up that everyone likes, and it really comes out of nowhere. This would be something that could have an immediate spike, as an example, because people didn't anticipate that. But when you can anticipate that something is coming, there is no reason why you should see these immediate spikes after the event. It doesn't make any sense whatsoever. Now, that being said, I mean, who am I to argue against the data? I can tell you from a theoretic point of view, when you think about it, when you model it, when you look into the economics, it doesn't make any sense. But as a matter of fact, when you look at the data, we have these three events, and every single time that's what happened. And one potential explanation for why it happened is because it essentially could be a self-fulfilling prophecy. So when people start arguing right here that, oh, there is this halving, and now, of course, since it's halved, it must be worth much more, and everyone believes it, and then maybe they talk about it, maybe there is an increased press coverage, media coverage due to this event, maybe there are new people coming in, then it really could be this self-fulfilling prophecy, even though there isn't any new information and it has already been known right here. And yeah, as I said, it doesn't make too much sense, but that's one potential explanation why we can observe this effect. But you have to be aware, once again, when people tell you this has always to be the case, no, it does not have always to be the case. Again, it doesn't make too much sense economically. It could just as likely be the case that you have a decrease after halving, or stable price after the halving, or you name it. It just happens that so far it has been the case that for whatever reason we have always experienced this price increase after the halving. Now, another group of people will tell you that Bitcoin is inherently deflationary, and they usually use two arguments. Number one is they're saying that you will have an ever increasing demand. Now let's take a step back and first look at the graph right here. And as always in economics, price is really just a function of supply and demand, and for any given price there will be a certain quantity supplied and also a certain quantity that is in demand, okay? And you have this clearing market right here, so at the intersection you have a certain price and a certain quantity where the market will be cleared. That's really economics 101, something you learn in your first class of economics. And one of the, again, relatively flawed arguments you will hear from many proponents is that Bitcoin will have an ever-increasing demand. And of course, when you would make this argument, when you have an ever-increasing demand, you would have the shift of the demand curve right here. That would lead to a higher price given a certain supply. Again, the supply is relatively constant. At least it's adjusted in accordance with this predefined schedule. So this should lead to higher prices. But it's a flawed argument, because why are you coming up with the assumption that Bitcoin will ever increase its demand or in demand? I mean, certainly there is a point where the demand of Bitcoin would decrease. That doesn't make too much sense. Yes, of course, you could say that potentially there could be a higher interest in Bitcoin, more people coming in, new users coming in, and certainly we haven't reached a point where that is not possible anymore. I mean, absolutely, there might be new people coming in, there might be a bright future for Bitcoin, but just making the argument that there will be an ever-increasing demand for reasons doesn't make any sense whatsoever, and economically is completely flawed. What, on the other hand, is somewhat fair to say is that the supply is limited, of course, so you have this constant supply, or in some cases people even argue that the supply at some point will be decreasing. Now, why do they argue that? For the simple reason that people lose private keys, that people lose scripts, people lose the ability to spend their coins. And for that reason, it might really be the case that Bitcoin has in fact a decreasing supply at some point. So when the introduction rate comes down quite a lot, and then people are losing significant values of significant numbers of Bitcoin, significant numbers of these keys, then this might be the case. And here, when we assume that we have a constant demand, then of course this would also lead to higher prices. But again, it entirely relies on the demand side, it entirely relies on the fact that demand remains unchanged. And that's, again, something we cannot predict, because it relies on all of these assumptions. It relies essentially, once again, on the expectations of people. And this leads us to the question, will the value of Bitcoin increase forever? And obviously the answer is no. Nothing is going to increase forever. That's quite obvious. Then again, you could ask the question, so how long is it going to increase? And I can tell you, I don't know. And I can also tell you, nobody knows. Once again, and I know I keep repeating myself, but it's really important to understand that when you have an asset with no fundamental value, with no intrinsic value, with no promise for delivery attached, really anything you're observing can be in equilibrium. From a monetary theory point of view, 1 billion is just as good of an equilibrium as 0. I mean, you name it. It could be really any fantasy price right there, because you don't have anything you can compute it on. You don't have any grounds where you could make the calculations. Where you could say, as I've mentioned earlier, of the example of the discounted cash flow model, this is a fair price. It doesn't make any sense, because essentially the fair price is whatever people are willing to pay for it, and the number that people are willing to pay for it, the price people are willing to pay for it, entirely depends on their expectations. So depending on their expectations for what price they can sell it in t+1, so in any of the future periods, this may change their willingness to pay today. And as a matter of fact, there are really these two types of equilibria. Number one is price equals zero, so where no one would accept Bitcoin anymore. I don't think that is likely to happen, zero, because there are some really hardcore proponents that would literally buy out any of the Bitcoin before this would happen. So I don't think we're seeing this, even if it's just for as a collectible, as some piece of monetary history. I don't think Bitcoin will ever go to zero for these reasons. But then, of course, you have all of these equilibria where Bitcoin has any price above zero, and we cannot reliably predict where it's going. And this is really important. This is the key takeaway for this class, for this lecture today. I mean, don't trust anyone that is telling you I can predict Bitcoin price. I can assure you they cannot. They have no idea, not any more than you or me. All right. So last but not least, I mean, we talked about Bitcoin as a monetary unit earlier, and I made several times the argument during this class that even though Bitcoin has been conceived as a monetary unit, as something that can be used as digital cash, I think it has much stronger properties in other areas. So if Bitcoin succeeds long term, I think it will be rather used as something that could be described as digital gold. I don't see it, at least not today, as a payment instrument for everyday purchases. I think its price volatility, its characteristics, its conversions to a fixed capped supply don't necessarily make it a particularly good monetary unit for everyday purchases. The characteristics may potentially make it a good long-term store of value, but not something you're paying your cup of coffee with. Also, of course, there are some technological constraints, as I've shown you throughout the class, and also make it hard for Bitcoin to reach this goal. But there is a really interesting quote by Satoshi Nakamoto from the early days, and it seems like they have foreseen in what direction it could potentially go with Bitcoin. They said, as a thought experiment, imagine there was a base metal as scarce as gold, but with the following properties: it is boring grain color, not a good conductor of electricity, not particularly strong but not ductile or easily malleable either, not useful for any practical or ornamental purposes, and it has one special magical property: it can be transported over a communication channel. And I would actually add something to that. I think that is something that is really important, but it's not, as far as I'm concerned, not the only distinguishing factor, because this is true for literally any digital asset. What is really important is it is censorship resistant. It is something that is immutable. It is something you don't have to ask anyone else for permission to transfer it, to hold it, something you can really store for yourself. And these are really exciting properties, not necessarily in the context of a monetary unit, not necessarily in the context of a everyday payment instrument, because there might not be that important. But when you're trying to store something long term, and you might be at risk that there is some expropriation, let's say, or some inflationary pressure, or some issues with the financial system, then this might be a great alternative for diversification. And I'm not saying that this will be the case, but it certainly is good to have this option. It certainly is good from an economics point of view to have this technology out there that may protect us from certain bad outcomes, certainly certain bad states of the world that could potentially arise. And yeah, that's from my point of view, Bitcoin. not necessarily a payment instrument, but really a potential version of digital gold if it happens to exist in the long run. So with that, stay curious. See you soon.